All right, welcome back to the podcast. My name is Doug Sandler from Turnkey Productions. That guy over there watching out for falling iguanas, that is Mr. John Browning. You said something before I hit record, John. I didn't realize you had iguanas just falling, just dropping from the trees there.
We do sometimes. That's there's a lot of hazards in Florida that we live with. We basically if there's a wet spot, there could be an alligator that could potentially eat you. And if it gets a little bit chilly down here in Florida, you actually do have iguanas falling out of trees. So like little baby dinosaurs raining on you.
Wow.
Yeah, so
Is
that's
is
fun.
there an umbrella or some sort of cage that you can wear over your head to kind of lessen the effects of a falling iguana on your head?
That's a
Amazing.
good question. Maybe I should invent that. See,
That could be a good. It would only work in South Florida, though. I don't think it
that's right.
works
It would only work here. Yes.
nowhere else. Nowhere else. Well, let's talk about a subject that is far less volatile, but far more profitable. Let's talk about this thing that I know we've chatted about it before on previous episodes, but today we're going to take a full episode dive into this thing called dollar cost averaging. Is it brilliant? Is it boring? Or is it maybe a little of both? So this sounds like this is a subject that is near and dear to you. Is that correct?
It absolutely is. Yes, we talk about this a lot. It's a fairly simple idea, and yet seems so difficult for people to get their minds around and actually execute on it.
All right. Well, let's start with I can either read you the Google AI definition of it, or you can share with our community a little bit about the definition behind dollar cost averaging and what it's all about.
Well, that's interesting. I should have looked up the AI definition of it. I mean, to me, what it means to me is that you are consistently investing over time in regular intervals, same amount, roughly the same amount of money over time. Once a month, once a week, once a day, or whatever. You have some sort of consistency with it in the same dollar amount. And that's dollar cost averaging into the market. They also refer to it as DCA because you got to have an acronym for everything.
Oh yeah. See, that would be the major airport in the DC area. I think that's Reagan National or something
That's
like that.
right.
I
Yes.
believe that's the same acronym for it. Okay, so it is taking an investment on a regular basis, same amount, putting it into the. I'm assuming you mean into the, or maybe you said this and I just missed it because my cat is trying to find a comfortable position on my lap to sit while I'm recording today. Thank you, Winter, for settling in. Taking the same amount of money on a consistent basis and putting it in the same investment, like if I'm
Yeah, and the
investing in
same
stock.
investment in the market, whether that's, for you, whether that's an index or an individual security or a group of individual securities or whatever that is. Yeah.
So when you do that, it sounds like when the market is high, you're buying a lesser amount of that stock. When it's lower, you're buying more shares of that stock, and on average, it sounds like it will help you improve your chances. Nobody can time the market, so it's just helping you improve your chances on having a winning stock opportunity. Is that right, or is there something else behind it?
Yeah, essentially that's the idea. It reduces your volatility over time. It reduces the risk because what people tend to do is they like, oh, I like that stock, I like that company because it was in the news today. So let's just buy a whole slug of it today. Well, that could be the day before somebody makes an announcement in the news or a tsunami hits California or
I got it.
something happens and that stock suddenly takes a dive and it's down 20 or 30% the next day because that can happen. That does happen, even though over the last month or so it doesn't seem like it could. We have short memories. It
It's
does.
it's crazy. I mean, I don't want to time this podcast. I like to keep it evergreen by not necessarily saying where the market is. However, recently the market has been such on an uptrend. It's like anything that you're putting your dollars into right now, including crypto, seems to, crypto went over X amount of dollars. It was a big number for it to go over, and then
Yeah.
it dropped down to some people took some profits. It went out, went down again. But But if you were dollar cost averaging on an individual stock or on a EFT or any of the things or ETF or ETF, exchange traded fund,
Yeah,
ETF, right? I got it right. If you're investing in anything in the market, it sounds like you're hedging your opportunity to win. Um,
that's right.
you're doing it consistently, which I think is another big challenge that people have. It's just the consistent. I always talk to my son about just if you're putting $100 in the market, don't put it in today and then not again another 6 months or a year. Put
Right.
$100 in again next month, and then put $100 in the next month, and the next month, in the same investments. Does it work for everything that you're investing in, or when it comes to the market, or is this only work for a certain type of stock?
It really works for just about everything. The only thing I can think of that might be an exception is if you just want to have some real safe emergency money and you're putting it into a money market fund or something like that, or a high yield savings account, then it doesn't really apply to that. But pretty much everything else it can apply to.
Okay, so take me through the practice of doing this. So you have a client that comes to you and they say, "I want you to handle my money." And one of the things that you talk to them about is this practice of dollar cost averaging. Take me from there. What happens? How do I set it up?
So, I mean, typically, if you're not on a fixed income, which some people in retirement are on a fixed income, and we can talk about that because that's no excuse not to
Right,
dollar cost average.
right.
But typically, what we set up is we set up an automatic draw, just like you would pay your car payment. You're paying your future self a payment.
Mm-hmm.
So you're buying months, weeks, years in retirement, say, or you're buying a share of that boat that you want to buy, or whatever it is that your goal is.
Mm-hmm.
Every single month, you're making a payment to yourself, and you just automatically draw it out of the savings account. We put it to work in the portfolio. We put it in a percentage that makes sense across all securities in that portfolio, and
Mm-hmm.
we do it. Usually it's monthly. Sometimes it's every time they get a paycheck they want to do it. So sometimes it's twice a month, or 3 times a month if they get paid, the other way. But pretty
Right,
much,
right.
it's once a month. I don't recommend doing it like once a quarter if you
Mm-hmm.
can. If you can avoid that, that kind of defeats the purpose again, because you're putting a
Right,
bigger slug in.
right.
But yeah, once a month, just take that draw. It's just like paying your car payment, your utility bill, or whatever. But instead of it going to the utility company or the bank, it's going to your future self.
How does it differ, or how does it differ if it does, from taking a slice of my income and putting it in? Like right now, the way that I work is I work through my paycheck. So out of my paycheck comes X amount of dollars every pay period, and that's once a month for me, self-employed. I pay myself once a month. Out of that, off the top comes a percentage. That percentage goes into all of my funds, and then they are direct. I'm assuming that's it. I'm using the practice of dollar cost averaging, but just not calling it that. Is that right?
That's right. Yeah, and many people that are listening to the podcast today are saying, "Well, I'm doing that. I've got my 401k and it comes out every paycheck." And
Yeah.
they're correct. That is a great way and a very disciplined, consistent way to do it, as long as you don't go in and change your allocations, right? So that is one way to do it. I often talk though about being invested outside of your 401k at your work. It's a very important concept, a different topic, but just keep in mind that those 401ks, as much as they seem like they are free, they are not.
Got it.
And if people say, "Oh, you must first max out your 401k," and that's not necessarily the case. You have to do a little math on that, or you should do a little math on that to determine whether or not you should actually keep it all there or not.
All right, so make it make sense. I know you use the word, so I'm going to give it back to you. The word math. Make the dollar cost averaging math work out so that I can see that it's actually beneficial to me to do that. I know it's a long-standing philosophy. Look, dollar cost averaging will work to your advantage in the long run, but is there specific science slash maths that are involved with this?
We can math this.
All
Yeah.
right, let's
Use it as a verb. Yeah.
math it for me. Math it.
So if you've got say you're taking $10 and you're going to put that into, we're not going to say a portfolio, we're going to say a security. So
Okay.
$10 into a security, and it's $10. So you get one share,
Okay. Ten
or
dollars,
maybe
$10 a share. It's today. So I bought one
$10
share.
a share. Maybe it's $20. So you buy two shares. Let's make it interesting, right?
Okay.
The next the next month it's fallen. We're sad, but since we're still investing $20,
Right.
we now have 2.22 shares of that particular stock, right?
So immediately I already see the advantage of it, and now I'm buying more stock. Now I would look at it and think, oh man, the stock price dropped, so I lost money on that original $20 investment. However, I'm investing $20 again this month, and I'm buying a little bit more because the stock value is lower, thereby lowering the average cost that I have spent on that stock, as opposed to spending $20 once and getting two shares. Now I have 2 plus 2.2. So now I have 4.2 shares of that or something
Right.
like that.
Yep. And so, okay, so John, but the market, what if the market goes up? Then I don't get as many shares. And you are correct.
However,
Correct again. So if it falls a dollar, you get 1 point, what is that? 1.8, 1.82, I believe, shares. So, oh, you were so sad because the market went up.
yeah,
This is the
yeah.
only market in the world where my wife doesn't get excited that when it's on sale.
I got
So
it.
if you're dollar cost averaging, not only do you mathematically get ahead of the game over time because it's just the way that it works because you're being consistent and you're buying more shares as it goes down, which then, since you have more shares, it goes up more quickly when it goes up.
Hmm.
So you get that concept, right? Because you
Absolutely.
bought more shares, when it goes up the same amount, you're actually up more.
Yes.
So that's a good thing. So that's why the math of it works.
Is
And then,
there, oh, sorry,
yeah,
go ahead. You go.
no, you go, you ask.
Is there ever a time when I mean, a continuing dropping dollar sign still potentially has a winner. I mean, share price has still potentially has a winning opportunity for you because at some point you're buying exponentially more shares the lower that it drops with that same $20.
That's exactly right. That you have the concept. Yeah, that is exactly 100% correct. And I could give you with the caveat, once again, as always, this is not investment advice. Just
Hmm.
because I mentioned the name of a stock or a company doesn't mean you should go out and buy it, sell it, hold it, or
Got it.
anything else. That would be a conversation that we can have together on a one-on-one basis. But you take, for example, if you have done your research and this is a good quality companies trade down in price all the time.
Yeah. Yeah.
Just it happens, news article or whatever happens, a lawsuit, whatever happens. So you take a company like Palantir, which I'm sure some people have heard of now finally because it hit the S&P 500. They're doing all kinds of really cool stuff. Guess what? They were doing all kinds of really cool stuff years ago. And their financials were good, their business model was good, and everything else. So you were buying those shares at, I happen to purchase shares as low as $4, $7. It traded up to $83 the other
Wow.
day.
Wow.
So, but because we dollar cost average, and even though at one point it was up at 15, 20, 30, 40, and then it fell all the way back down to 10, we kept
Mm,
buying because it was still a good, solid company. There wasn't anything that had fundamentally changed. Over time, your average dollar cost average price got you way ahead of the game.
very interesting. Okay.
But if you had said, "Oh, this is a great stock. I'm going to buy it all," and you bought it all at 30 or 40, you
All at one time,
all at
all at
one
one.
time, you
Right.
didn't do nearly as well.
Is there ever a point where you say, okay, I've got enough in this, but I guess that all just depends on your portfolio management and how you like to diversify as an advisor for those that are your clients. So eh, there there you don't follow any different investment philosophy. You're not determining the types of stocks that you're buying. You're just talking about your investment strategy. Now, are there other strategies that ride along with dollar cost averaging that work as well, or work in conjunction with dollar cost averaging?
For sure. Absolutely. We like math here at Guardian Rockwell, although my third grade teacher would beg to differ. I didn't do well. But I've grown to really love math because it works for me. And managing by the percentages works really well as also. So no matter how in love you get with whether it be Palantir that we mentioned or Tesla that we mentioned, and I
Hmm.
disclose that we own here at Guardian Rock, we own both of those, and it's not investment advice. You should not go do anything based
Got it.
on that. But no matter how much I really like those particular securities, or maybe a sector like the tech sector,
Yeah.
they can always go down, and they can go down hard. Especially the tech sector can go
Yeah.
down hard, but other sectors can go down pretty hard as well. Even the quote unquote safe utility sector that can go down because of geopolitical events, things like that. So keeping your percentage ownership at a certain level and being disciplined in your sell discipline is very important as well. Like that's
Mm.
something that we should talk about that on the whole
Yeah.
when to manage your when to buy, when to hold, when to sell, that kind of
I
stuff.
wrote that one down. I know that that'll be a subject of a of an episode that we're going to record very soon. So I'm really interested in it. What else can you tell me about dollar cost averaging? It seems like it's so simple. Why isn't everybody doing it? It's kind of like why isn't everybody putting money in their 401k?
It's
Why aren't we all doing it?
it's emotional, just like almost everything. It's what kills every investor out there is their emotions, because we all make decisions on an emotional basis, whether we like to admit it or not.
Yeah, but we're all paying rent or a mortgage payment every month too, and it's like we're not questioning why am I continuing to pay a rent or a mortgage payment? Why aren't people as invested in investing as they are in paying their bills?
I to me, it's because it's not as immediate. It's not. It's difficult to get people to understand that it is as important as the roof over your head, the food on your table. Maybe not as important, but to your future self, it is as important.
Mm,
And that's why I try and use the analogy: you're paying your future self. You're buying an extra month, an extra year of retirement when you're doing this.
yeah, I think it makes a lot of sense to do it. I think I have been engaged in dollar cost averaging. That was always my let me set up a monthly budget that includes what I'm putting into my investment accounts. Now, I'm not a wealthy man by wealthy standards, millions and millions and millions of dollars sitting in the bank, but I feel like I've done this right over the last, I'm just turned 60. I've done this really well over the last, 35 years. If you do it even for a short period of time, even for a few years, you start to look and see the benefits and the results. And even though there are up markets and down markets, I always find like I don't not a stock picker. I'm not a winner when it comes to that, but man, I'm a winner as it relates to consistently putting money away because I am paying my future self, and that's how I look at it too.
Yeah, yeah. And there are other ways to look at dollar cost averaging. If you like, for my rocket scientist clients that I have out there, I have a few of those. They're accountants, or I really need to make this more complicated. Really, no, really, I do. So there is a way. So I'm going to mention that, just so we can end the podcast on this. So if you didn't stay to the end, you're going to miss it, right?
Uh-oh.
So this is modified dollar cost averaging.
Okay, go ahead.
And for some clients and some people, this can work really well. And it makes it maybe a little bit more interesting if you're a little bit more aggressive or what have you. But the idea is that, but again, it involves math, and it involves discipline, and it involves consistency.
Okay.
So you take that same amount of money, but you only take maybe 75% of that money and purchase that stock or that portfolio. And the other 25%, you put it in a cash balance, like a money market fund or something like that. So it's
Yep.
still earning interest, still working for you, but just not, say, in the markets.
Right.
When at some point during, because this always happens at some point during the year, you have a 10% pullback. Some people use 15, some people use 5, whatever. 10% tends to, when I've done the math of it and back tested it, 10% seems to work really well.
So what you're saying is when the market drops 10%, is that what you're saying?
Yes.
Okay,
When the
so if you have,
market or the particular security that you're buying
got it.
drops 10%, you take that cash money that you've built up over time and
Right.
you pop it over there.
Wow. Okay. So let me just play this out. So you're investing $20 a month total, whether it's 15 a month in your in the stock and $5 a month in your money market. The end of 6 months, you got $30 in the money market, and we don't know how much you have in this in the stock because it's gone up or down. But
Right.
tomorrow it goes down 10%. Next month, do I start, or the day that it drops 10%, or do I use the 10% as the trigger point for doing the
The
move?
10%, the 10% drop is the trigger point.
Got it.
So
Okay.
when you see it drop 10%, you put it to work in the portfolio or the
All,
security.
all of the rest of it, all the stuff that you've put in the money market, that was going to
Yep.
be earmarked for the dollar cost averaging.
Yep.
Okay, so now we've taken that, and we're when it's dropped 10%, we're now buying more of that stock because it's 10% lower.
Right. Right. And the math of that, if you back test it against like something generic like the S&P 500, works really well. It's pretty fun.
Interesting.
It's pretty fun to do that math.
I have not ever heard of that, but I am now intrigued enough to sample try it.
Okay.
To see
Let
how it
me know
works.
how it goes.
And
It's going to take you a year or two to figure it out, but yeah,
no
it'll.
worries. Well, when you're doing dollar cost averaging, are you doing it with your entire portfolio, or are you doing it with just a section of your portfolio? Talk to those that are in our community that are like, well, okay, but I'm already giving my broker, $1,000 a month, and they're putting it in investments. I thought that they were dollar cost averaging. What am I missing?
Well, they should. I mean, technically, they should be doing that for you, right? They
Right,
should
right.
be doing it in a way. So that should be worried. If you're doing it, if you're giving your financial advisor whatever $1,000 a month, they should be taking care of that for you. That's our job, right? Is to do that. You don't have to worry about it.
So somebody's saying to you, I wanted dollar cost average. That's been a client of yours for a while, and listening to this, you're going to say, "I'm already doing that for you."
Yes,
Is that what
that's
you're
right.
saying? I'm already doing this for you.
That's right. Although you'd be surprised, some clients are like, why don't you do this? Why, they always ask, and we go over it or, but yeah, people forget because it's not what they do every day, right? They're really good at whatever it is that they do.
I got it. Okay. Anything on that subject that I am missing? Anything that I should be knowing that I don't know? It sounds like it works in any environment. It sounds like it works with a number of different financial products. It sounds like it works even if I want to screw up the math and to make it complicated. You've even given me an opportunity to complicate it a little bit. Anything that I could do to simplify it?
Not really. It's about as simple as it gets. The only other thing I'll add at the end is I get a lot of excuses, and that's what I call them excuses. Well, John, I don't have any disposable income every single paycheck. Or, John, I'm on a fixed income. I'm in retirement. I can't dollar cost average anymore. I'm going to beg to differ because if you set up your portfolio correctly, it should be producing income. And this is what I talk about this quite often is that no matter where you are in your investing career,
Mm-hmm.
always have a portion of your portfolio creating income and use that income to dollar cost average into the other portions of your portfolio. And that's a powerful tool as well.
How do you get out of the boring side of it? We talked about brilliant, boring, or maybe it's a little of both. I mean, boring is not boring if you're making money. I always look
Boring
at
isn't
the.
boring if you're making money. And that's where the brilliant side comes into it, I think. So
I got it. I got it. All right. Any final words before we wrap up on this?
that's it for me.
All right, excellent. Well, stay tuned. We got a lot more information about some of those other things we talked about, buy, sell, and hold. We're also going to share in an upcoming episode the power of zero taxable income in retirement. I know John and I have set up a couple of really cool subjects for you guys to want to listen to. John, if those in our listening audience want to get a little bit more information, or maybe want to touch the hand of the shepherd, you being the shepherd, how can they do that? What's the best way for them to reach out to you?
Best way is to go out to guardianrockwealth.com, or second best way, real close second, I think, is to grab your cell phone, dial this number in your texting app, 321-421-5213. And that's going to, and you put the word life in there, send that in, and that's going to give you all kinds of free links and a link directly onto my calendar. And I'm happy to speak with you no matter where you are in your financial journey. I will speak with you. If I'm not really able to help you for one reason or another, I almost certainly know somebody who can, and I'm happy to direct you there.
All right. Well, excellent. Well, thanks for sharing, John. Yet another week of your expertise. Watch out for falling iguanas in the upcoming
Yes.
weeks and months. Thanks for being
It's
here on the
getting
show.
cold here. I was down to like in the 40s. It was like, oh man, you don't know what to do with that.
Stay away from those trees and those iguanas. All right,
Yeah.
John. Thanks for being here. Thanks for sharing again.
All right.